An historic sell-off for stocks. The Dow tanking just over 10% this month. Its worst June since the Great Depression. So is it time for you to panic, or time to turn everyone else's panic into profit? Hi everyone, I'm Brenda Butner and this is Bulls and Bears. Let's find out what's next for your stock in the trading day. Here are our Bulls and Bears this week. We've got Gary B. Smith, Tobin Smith, Pat Dorsey, along with Matt McCall and Peter Schiff. Welcome to everybody. Okay, Gary B., is that bull or bear in your name?
The B stands for bull, Brenda. Just like it was at the March lows, we took off from there. I think we're about to take off yet again. Here's my rationale. One, I think oil has gone parabolic. If that's not a bubble ready to crash, I don't know what is. It looks like NASDAQ about March 2000 to me. Two, the bones of the economy are good. Everyone thought we'd be in a recession by now, and yet what has GDP done? It shows we're not in a recession. Now, maybe that'll occur later, but so far, all the doom and gloomers have been wrong on that regard. Unemployment is low. Companies are still making money. My gosh, Citigroup is now priced almost 70% below its high. I mean, I just refuse to believe that a stock like that can drop much lower, and a year from now, it's not going to be much higher. I would be a buyer right now.
All right. Speaking of doom and gloomers, Peter.
Well, I don't think anybody should panic. I think they should sell. I think that's the rational thing to do. This is a bear market. We've been in a bear market since 2000. And, you know, the market's going a lot lower, not only in nominal terms, but in real terms. You know, Gary might think there's no recession because he believes what the government says, but the government says the economy grew by 1%. But to do that, they claimed inflation annualized is 2.7%. If inflation is 4%, we're in a recession. If it's closer to 10%, which I believe, we're already in a severe recession, and it's going to get a lot worse. And I don't think crude's a bubble at all. I mean, Gary, you ought to take a look at the chart. It doesn't look like a bubble at all. It's a good chart. It just broke out again. It's probably going up to 150. And, you know, trying to catch a falling knife in the financials, they have a long way to go down. I wouldn't touch them.
All right, well, Matt, you know, bears come in different sizes and shapes. I mean, I'm not going to scoff at 10% down 1 month, but there have been many bear markets that we've seen much worse. In 1987, it was 23% down, and that bear market lasted 3 months.
Yes.
This might not be that long.
No, and you look back in history, going back to 1900, we've actually had 26 bear markets in that time frame. And you look back at the average, it's been about a 30% decline. So we take the Dow, we're down about 20% from the top now. That means we're pretty darn close to the bottom, even if we go into what we call a bear market. So selling here, what Peter's suggesting, is the exact opposite we should be doing. That's a panic, that's selling. When you make money, you buy when things are at good valuations. We're sitting at that now. I can't agree more with Gary. And plus, the amount that's in money markets right now, sitting on the sidelines, is at historical highs. Once this market starts taking off, it's going to explode to the upside.
Valuations are not good.
Okay, hold on. I just want to get Toby in here because actually you think being in money markets or being in cash is not such a bad thing.
Well, it's not a bad idea. Remember, what we haven't talked about is inflation, and not only just inflation in the United States, but I'm much more concerned about inflation in China and Asia and other parts, because look, you have the Chinese stock market down 50%. You have the European stock market that's down more than us here, guys. We've been sort of contained on our inflation because of our housing debacle, where I'm seeing two things. Is number one, as this, 50% of the population of the world now has inflation more than 10%. That means stocks are going to be worth less because inflation is taking a power out. The second issue is that we've got the second wave of the recession. And Gary, I'm sorry that 1% GDP. Usually there's a 1% plus or minus anyway in GDP numbers. And more importantly, we've had a bear market in almost every sector in the market. What we're doing is having the rest of the stuff catch up. I think we're farther to go. There's going to be a bounce. You know, like Gary of the trader he is, there's going to be a dead cat bounce. But on that dead cat bounce, I'll tell you the one thing I'd be selling, and that's if you were buying financials trying to look for a turnaround, boy, you got to sell them into this bounce.
Well, Pat, what do you think? I mean, you've heard both arguments. I mean, is there good reason for people to be selling right now other than the fact that they're just plain scared?
I mean, if your time horizon is anything beyond, say, 3 years, and I think for most viewers who have 401ks or they're saving for kids' college or for their retirement, selling now simply does not make a lot of sense. Lower prices today mean higher returns over the long run. I mean, that's the simple way the math works. And, we are likely in a recession. I'm certainly more in Toby's camp on that front. But, stocks tend to anticipate these things. When did the market start rolling over? Last summer, when all the economic data looked just dandy. So the stocks are going to come back when the economic data still looks pretty ugly. So I think right now, buying big multinationals like a GE or United Technologies, you're still getting exposure to emerging markets. These are companies with pricing power, which is good in an inflationary environment. I think it makes a lot of sense.
Now, GE's a hedge fund masquerading as a company. I would stay away from GE.
Thank you, Peter.
Well, what would you like, though, Peter?
Look at gold. You want to see a good chart? Look at commodities. Look at foreign currencies. We are in a secular bear market. It's been going on for 8 years. It's going to go on for another 5 to 10 years. If you want to wait that out in the U.S. stock market while inflation eats away the value of your principal,
5 to 10
you're not going to live long enough to get
Gary
even.
B., what do you say to that? 5 to 10 years.
I did a little research into gold, and I will give Peter the fact that gold has had a nice run lately. Gold also goes through incredibly terrible times. In 1981, an ounce of gold was about $500. In 24 years later, it was still about $500. So gold can go through a stretch where it dramatically underperforms the market. In fact, inflation adjusted, gold is still dramatically, Peter always likes to talk about inflation, dramatically down from its peak.
But
so,
we're not in that
hold
stretch.
on one second. And as for your other point about us being in a bear market since 2000, my gosh, inflation adjusted or not, the New York Stock Exchange, if you want to use that as a base, is dramatically up 40%.
The NASDAQ is down 50%, and the Dow is lower than it was 8 years ago. The Dow was at 11,750.
I'm just looking at a broad range of the market, whether you look at the S&P
and
or you look at the New York Stock Exchange. So I don't see how we're still in a bear market.
Yeah, inflation's not 40% of the value.
All right.
But
Peter, when you pick your starting point at 40 times earnings, of course it's going to be.
That's exactly right.
Well, that's when the bear market started. But gold was $35 an ounce in 1970. Why don't you take a look at that time frame?
Okay.
This is one of the times to be in
right
gold.
now.
Okay. Okay, Matt.
Well, my head's spinning right now, to be honest with you. But really, Gary made a great point. Look at the long term with gold. You really haven't gone anywhere. You look at the long term of market, you're going to continue to move higher. Over the last 45 years, we've only had the worst losing streak we've had in Dow has been 3 years.
Yeah,
so if you're going to try to time this market, Peter, to be honest with you, investors out there trying to time this market are not going to make money.
In 1929, the Dow was worth 20 ounces of gold. Now it's only worth 13. It's gone down over the last 100 years.
All right. Thank you, Peter. I just got to get to Toby, or he'll kill me next week. But, in many bear markets, you get rallies, sharp ones, 5 to 10%. If we get one of those, are you selling?
Well, I think that you're going to get a bounce because we're so way oversold. The sentiment is horrible. Probably in the next 5 to 6 trading days, you're going to see this, oh my gosh, world's coming to an end. And then as soon as those people jump in a short, this market's going to be up 10% in a week. But the bigger issue is we're underestimating how damaged our financials are. And I go back to Citibank at $9 to $10 in 1990. Our target was $16 for Citibank. Our target now is $12 because the bad news is not priced in. And I don't want to see people out there, chasing.
Okay. All right. Great debate, guys. I know we could talk a lot more about this, and we will next week. That does it for the trading this week.